Hi everyone! Today I'm going to explain the steps I took to reach my ending APV in the year 2014 in our capital budgeting simulation. Although my APV did not reach the number that is necessarily deemed a good APV, I will still tell you a little bit about how I made my decisions and what I could have done differently. So to start, I began in the year 2009, which you can see right here. I observed what my beginning revenues, net income, and operating incomes were. So as you can see, my beginning revenue in 2009 was $245.75, and operating income $22.60, and net income $13.56. Now in the current year, my revenue is $342.14, operating income $37.49, net income $22.49. So each one of them went up, which is good. But they just didn't go up quite enough to result in an APV that was, well, necessarily good. So, I also liked to determine where my profits and such were coming from in each category in terms of production, retail, and licensing. So if you look down here at this little chart, you can kind of see how it all breaks down. When it came to revenues by division, it looks like that most of my profits and revenue was coming from the retail department, followed by production and then licensing. With operating profits by division, most of my profits were coming from licensing. Licensing obtained a large majority of that one. And then secondly was production and then retail. Lastly, with total assets by division, the majority of my assets came from production, it looks like, followed by retail and then licensing. Now, the goal of the simulation was to make informed decisions when choosing between project types to pursue for the company. There were both independent projects and mutually exclusive projects, and it kind of just had to be determined which projects were the best to make the higher APV for your company. When it came to mutually exclusive, I tried to choose the ones that I thought would result in the best income and best profit for my company. Independent, it just kind of depends. I just chose what I thought would be the best. Now the goal are by utilizing the capital budgeting tools, including like the NPV, payback period, the IRR, etc., I narrowed down my options and chose the ones I felt most confident in choosing. If I move over to this tab, this is where you can see the projects that I chose to invest in. So under the project updates, you can see that I chose to invest in the following projects for my company. In 2009, I chose to invest in the new doll film DVD, as well as the retail store expansion in the Northeast. In 2010, I only chose one, which was the Tween book series. In 2011, I chose the acquisition of a children's magazine. In 2012, I chose to do two, the expansion to England and the virtual doll community. And then lastly, in 2013, which was the last year right before my final results in 2014, I chose to invest in two, the Toddlers Music CD series, as well as the coupon promotion and frequent shopper campaign. So those were the projects I chose, and now I'm going to kind of tell you about the steps I took to determine which projects to invest in. To get to these projects, I examined a large array of information to make my decision. To start, I looked over the income statement and balance sheet for each branch of the operations. So if I move over here to the IS and BS tab, you can see how it all breaks down for each category throughout each year. So it expands from 2014 to 2024, and it just let me look at the net assets, net total liability, and shareholders' equity, as well as the net income. So when I looked at this, my goal was to ensure a steady rate of increase for my net income, which you can see from 2014 it moves from 22.49 to 41.48 in 2024, which is good. It means that my net income is steadily increasing throughout the years. It could be higher and it could be increasing by more, but overall it's increasing, which is a good sign. You can also look at it as it is broken down between retail, so the net income for retail is also steadily increasing, which is this one right here. The production, also steadily increasing, and licensing is steadily increasing as well. So that's all good indications that this is going to be successful, but there's so much more to analyze and determine whenever we're trying to make decisions, so I will move on to show you what else I did to make my decisions. With the cash flows tab right here, you can see that it gives you a cash flow statement for your future projections for your company decisions. I looked at it very similarly as I did with the income statement and balance sheet. As you can see here, my overall cash flows is predicted to steadily increase, but both my investments and financing cash flows will decrease, which could be a problem. So here, the total one goes from $17.88 in 2014 to 2024, $30.06. That's good. It's increasing quite a bit from $17.88 to $30.06. However, if we jump down here to investments and financing cash flows, they both start out higher and end up in a much lower negative number, which could be a problem and something that we might need to check into and could indicate less success for the company. In addition, I really utilized the project details tab. I found it to be very useful in making decisions and getting a large amount of information all in one location. It allowed me to see the future projections of net income, ending cash balance, and net assets for all of the possible projects I chose to invest in. So as you can see here, it lists out all the projects you can choose from, and when you click on one, which I'll just choose the expansion to England, which is one I chose to invest in, it breaks it down by each category for you over future years from 2015 to 2023. So as you can see, here are the future projections for one of my selected projects. You can see that net income is steadily increasing, total assets is steadily increasing, as well as ending cash balance. So that's a good indication that this project might be a good one to invest in. Each year, as I compared possible projects, I compared their net present value, profitability index, internal rate of return, and payback periods. When it came to the NPV, I was looking for a higher one. Anything that was positive indicated a potentially good NPV. For the PIs, I was seeking any PI that was greater than 1. So if it was greater than 1, that indicated that this is good, it could be a potential success. For payback periods, I was looking for the shorter the better. A shorter payback period indicates that you will break even and make more profit quicker. So, for example, if I had one project that was a payback period of greater than 10 and one that was, say, 3 years, the 3 years would be much more appealing because that means you're going to start breaking even and making profit much more quickly than you would with the other option. Lastly, in terms of the IRR, I was looking for higher positive numbers that indicated I would make more than the required rate of return. So it's a good idea to kind of compare the IRR with the RRR when you're trying to decide which project to choose, because the higher the IRR in comparison to the RRR, this indicates that you're going above and beyond the required rate of return, which is obviously a good idea to do. If we jump back to the project details tab, you'll notice that it also gives you the risk associated with each project. When it came to analyzing company or project risks, I approached it with the mindset of big risk, big rewards, small risk, small rewards. So with big risk and big rewards, it means that more things could go wrong, but it could also lead to more success or greater failure. It just kind of depends. With small risks, it can lead to less successful income and profits for your company. So it's something to consider when you're looking at the analysis when you're trying to decide which project to do. In the end, after conducting all of my analysis and making the best decisions I could, my APV was only $452.63, which you can see back here on our dashboard. $452.63, right there. This is very much not ideal because the goal APV is normally between 600 and 800. However, I do think I can say that capital budgeting tools are useful in better making informed decisions about potential company projects. Anyways, thanks for listening, everyone.